Welcome to Pharmacist YouTube channel. So for today, we have technical indicators. So if you guys haven't seen our previous video, which was posted last week, we covered all these bullet points, which are trend lines, support and resistance, patterns, and stop losses. I recommend you guys to jump right into that video if you guys want to continue and watching this video because the topics that we covered last week is necessary for us to understand this week's topics. So for the overview, we have all these 6 indicators. I'm going to start with moving averages. Just a hint, for me, it is not wise for you guys to pick just one technical indicator to base your decision making in longing or shorting a stock. Typically, traders combine multiple indicators to fit their trading strategy the best. And also, there are hundreds of technical indicators, but it's impossible for me to discuss all of them. So I'm going to pick the 6 most commonly used ones, and I target specifically on those indicators that relates volatility, volume, and price change. So we have moving averages. Moving averages is one of the most basic technical indicators that every traders must know. It's a lagging indicator, and it basically calculates the average of an desired time frame. For example, if I'm interested in knowing the moving average of let's say a stock for 3 period, and the last 3 prices would be $1, $2, or $3. So what I would do is I would add all these 3 prices and divide it by 3, as simple as that. So the example that I just gave you was the small moving average. What I have for you guys, another one is the exponential moving average. So if you look at the formula, it's a bit complicated, a bit intimidating, yes, but if you look at the formula, it says value today, which is the current price times the smoothing over 1 plus days, which is basically a multiplier, where smoothing is equals to 2, just to smooth out the formula, plus the previous EMA, the previous exponential moving average, times 1 minus multiplier. The EMA yesterday one, which is the previous exponential moving average for period 0, would be a small moving average. So to illustrate what's the main difference between EMA and SMA. So EMA puts more emphasis on the most recent price change, unlike SMA that gives an equal weighting for all period time frame. If you look at the chart that I show you guys for Intel Corp from Nasdaq, looking at the bar chart, important note that it's bar chart, not candlestick. From May 12 to 19 May, the price lies above the exponential moving average and simple moving average. But what I want you guys to look at is how EMA lies above SMA. It's because EMA, as I mentioned before, puts more emphasis on the most recent price change. EMA is more sensitive towards the most recent one. So a typical strategy that traders use is, for example, if the price lies above EMA, it means that for the next period of time, it is likely that the market is going bullish. Traders are predicting that prices are only going up, so that they will long the stocks. Meanwhile, if the prices are lying below the moving averages, it means that there's a possibility that the prices are going down in the future, meaning it's a good opportunity for traders to short the stock. So next, we have ease of movements. Unlike moving averages, ease of movements takes into account of the volume which affects the price change. It takes values from negative to positive, and if you look at the formula, distance moved is equals to the midpoint of the current price minus the midpoint of the previous price. Box ratio is equals to the volume over scale divided by high minus low, which is the range, and distance moved will be divided by box ratio. Although this formula might sound a bit complicated, do not worry, because in real trading charts, they actually provide the indicators, so we don't have to manually calculate it by ourselves. Mm, so if you look closely at the formula that is one period of EMV, uh, look at the denominator. So it would make sense that the denominator would be smaller if the range, which is the high minus low, is larger than the volume. And vice versa, the denominator would be bigger if the volume is larger than high minus low. And sorry, not to mention, if you look at the formula, you see there's a scale. Scale typically ranges from 1,000 to 1 billion, but usually traders use 1 million as the value, and it's actually dependent on the volume. Like the larger the volume, the larger the scale. Um, so, for example, what I have for you guys is a chart that shows a fluctuation of price. Um, if we look back at the formula again, as I mentioned before, if the denominator is larger, meaning there's a higher chance that the value of ease of movement would be lower, sorry, because it's divided by a larger number, right? So what I can say is, if the volume is low and the range is high, that means it is likely that the stock price change would be more fluid. It would be easier for the price to fluctuate, to move. Meanwhile, if the volume is high, but then the range is quite low, it's not as easy. So what makes it positive or negative? The main factor that causes it would be the distance moved. It's either the previous change is higher than the current change. So if we look back again at the chart, positive ease of movements means rising with ease. So for the first area of the chart, we see that the ease of movement is positive and it's rising with ease, meaning the volume is low, but the range is quite high. And the change of price for current is higher than the previous one. And vice versa, when the ease of movement gets negative and it's falling with ease, meaning it gives traders the opportunity to look at how the market is doing. If is if they see that based on the ease of movement, it's always constantly positive and it's always rising, meaning that they would see that the market is doing very bullish and it will keep on rising with ease. And vice versa goes when the ease of movement goes for negative. The next is force of index. Force index is basically we calculate the price change, which is the current and the previous one. Then we multiply it by the current volume. So similar to the previous indicator that I talked about, force index combines the element of price change and volume, and traders can use force index to predict the change in trend if there's some sort of reversal pattern, which was discussed by my colleague Sam in the previous video. So if you look at the chart that I have for you guys on the right, which is Best Buy from New York Stock Exchange, for the first part of the chart before the green line, it is going downwards. Price trend is going downwards, but looking at the force index, yes, it is negative, but it's increasing. It's increasing. It means that there's a negative price change, but it's getting there. It's getting larger, but it's getting smaller and smaller. As we see that there's a contradiction between the candlesticks and the force index, it's hinting that the price change would shoot right back up due to a bullish divergence from the force index. And if you see again, once it shoots up between March and May, the force index becomes quite passive and it's slowly decreasing, which hints another trend that the price change is going to negative again. So it's quite powerful. But as always, there's no indicator that has 100% accuracy, and typically traders combine those similar technical indicators to make sure that their decision making is good, because they will have a better they will have higher confidence in, since their decision is justified by multiple indicators. Thirdly, we have unbalanced volume. So unbalanced volume measures the buying and selling pressure as a cumulative indicator. I think the formula is relatively easy to understand. So, for example, if the closing price is above the prior closing price, then we add the current volume with the previous unbalanced volume. If the current closing price is below the previous closing price, then we subtract the current volume from the previous unbalanced volume value. If it's the same, then there will be no change. So what does this show us? So what this indicator shows us is that the value will rise if volume is greater during days when prices are up rather than down, which completely makes sense because let's say the closing price is above the previous closing price, then you would add the current volume, which shows that the value will rise. And actually, the inventor of this indicator firmly believes of the assumption that volume will precedes price, that there will be an action of volume first, then price will follow. Um, with a rising unbalanced volume, it implies that there's a simultaneous increase in price and volume, and vice versa. If there's a decreasing unbalanced volume, then there's a simultaneous decrease in price and volume. For example, here we have the Starbucks candles line chart from Nasdaq. If you look at the price pattern, as it's going quite low from the blue line, lower low, and you see the unbalanced volume line chart, it shows it's hinting there's a bit of increasing trend despite the price change is really going down, and it's proven to be true. After mid-July, the price spikes really high. Again, just a warning that this is not 100% accuracy. So there's always times where the indicators fail to perform, especially if you only rely on one. So next, this is a bit different than the previous indicators that I've mentioned because we're dealing with options now. Options trading. So I'm just going to touch a bit upon options. So for those of you guys who are unfamiliar with options, we have put option and call option. So put option basically gives the owner the right to sell a certain amount of security at a fixed price because they anticipate the price going down in the future. Meanwhile, call options is the exact opposite because it gives the owner the right to buy a certain amount of security at a fixed price because they anticipate the price is going up in the future. So if there are a lot of put options being bought, which means the market is, you could say it's going bearish, while if there are a lot of volume of call options being bought, then the market is heading bullish. So what's the formula of put-call ratio? So it's basically the volume of put options divided by the volume of call options. If the put-call ratio is larger than 1, as I mentioned before, it's going bearish. If it's greater than 1, if it's smaller than 1, then it's bullish. A real-life example would be, as we know that we have been hit by coronavirus for a few months already and the economy is slowing down. Well, there has been a bit of recovery lately, but probably for the next few years, it will take time. And it's represented by the put-call ratio, as the current ratio now is 1.73, which means that the put-call ratio is above than 1, and it's bear sentiment because, back again to the definition, that more people are buying put options rather than call options. because they're betting on the market that price are going down in the future. However, there are some views on the put call ratio because there are some contrarians that does the exact opposite. Maybe if the put call ratio is excessively high, let's say it's a 5 or 3 off the roof, they would think that maybe traders are being irrational, they're being rash. So they think that the stocks is oversold and it's the perfect opportunity for them to actually buy at that price point. Lastly, we have the volume price trend. Back again to the stocks market, the formula is we multiply the market volume by price change, and we add or subtract from the previous volume price trend value, uh, depending on the price change. It reflects the demand and supply. Again, there's volume is also involved, and it is usually paired with moving averages, which gives a signal line. So if you look at the example here, divergence example, looking at the chart above, the price is relatively increasing, but there is a specific period where it dipped really bad. And again, it's also represented by the price volume trend because back to the definition, there has been a negative price change. But what is interesting is that if you look closely, there has been a bounce since the dip, but then it is not really represented well by the price volume trend because despite there has been a spike in price, but the VPT, which is the volume price trend, remains relatively flat, which means that there might be an indication that there's a trend reversal in the near future because the price increases without strong support by the volume, meaning although the price increases, the volume remains relatively flat. And usually that won't stay long based on the indicator that we have here, which is the volume price trend. So thank you guys for watching. Please subscribe, turn on the bell notification, comment, and like if you guys enjoy. See you on the next video. Bye.